Our outlook for U.S. banks for 2019 is very positive. We think that we're going to see a good amount of price appreciation. And there's 6 themes that we're talking about as we head into 2019. The first is interest rates. The Fed has been moving over time to normalize interest rates. We believe that they'll have 2 to 3 more rate hikes in 2019. That has led to higher net interest margins for the banks, leading to better revenue, growth, and higher earnings. We think that that will continue with net interest margins improving in 2019 due to those rate hikes. Our second theme is on loan growth. Loan growth is still positive for the banking industry, and we're still seeing small banks grow loans at a faster pace than large banks. We think that trend will continue into 2019 also. Credit, our third theme, credit remains very strong. We see no signs of deterioration, and we don't believe that we're at the end of the cycle. However, we're prudently modeling higher credit costs into our earnings estimates because we know that it is a little bit later in the cycle, and we want to make sure that we're being conservative. We're still expecting 10% year-over-year earnings growth, however, even with those slightly higher credit costs. Our fourth theme is on consolidation. The industry has been in a multi-decade period of consolidation, and today there's about 5,500 banks in the United States. We think that number will be cut in half again over the next decade and think that multi-year period, multi-decade period of consolidation will continue in 2019. Our next theme is on the regulatory environment. We've seen an improving regulatory environment for the banks over the last 2 years, and we think that will continue in 2019, even with the change we saw in November with the Democrats taking control of the House of Representatives. We believe that because there's new heads of all the regulatory agencies of the banks that are more bank-friendly, that we can see a better regulatory environment in 2019. And that we think will lead to lower compliance costs for the banks and better operating leverage, higher capital returns, and potentially more M&A among some of the larger regional banks. And then finally, valuation. With the sell-off that we saw in the back half of 2018, we see very attractive valuations in the space. The price to book has fallen below 1.4 times versus a 1.8 times long-term average. We think that that's very attractive, particularly with an ROE of 11+% for the banking industry. And then on a PE basis, for 2019, the group is trading at about 10 to 11 times 2019 earnings. Again, a very attractive entry point, we think, for the space. So overall, for 2019, we're expecting very strong fundamentals for the banks and think that will lead to strong price appreciation.